Right now, tech giants are pouring roughly $725 billion into artificial intelligence infrastructure. But this massive global buildout is hitting a physical wall. For the last few years, the primary industry hurdle was simply getting your hands on the processors. Today, that constraint has shifted. The bottleneck is no longer the chips themselves, but the electricity and real estate required to run them. This power shortage explains why a tiny 83-employee spinoff out of New York has become one of the most volatile momentum names on the Nasdaq. WhiteFiber is positioning itself as a neocloud provider by securing its own power capacity while the rest of the market scrambles for access. They sit on a massive pile of contracted revenue, yet they burn cash fast enough to raise serious questions about their longevity. Determining if the company is an infrastructure powerhouse or a financial house of cards requires opening the ledger. We start with their speed. WhiteFiber uses a retro-first model, converting existing industrial buildings into data centers rather than building from the ground up. In Montreal, they turned a facility into a live data center in about 6 months. They are expanding their GPU cloud business into high-efficiency environments. Operations in places like Iceland offer the natural cooling needed to support massive compute clusters without the extreme energy overhead of traditional sites. This chart tracks the raw power capacity WhiteFiber has secured, specifically a 99-megawatt agreement with Duke Energy for their North Carolina campus. In an industry where power is the binding constraint, this secured capacity is their most durable asset. That secured power allows them to sign long-term tenants. Their North Carolina site is anchored by a 10-year agreement with Nscale, contributing to a total backlog of over $921 million in contracted revenue. On paper, the growth is rapid. Revenue increased 31% year-over-year in the first quarter of 2026, and they operate with gross margins around 93%. This graphic compares the market caps of WhiteFiber and its parent company, Bit Digital. Bit Digital owns roughly 72% of WhiteFiber, yet its own total market cap of $760 million is lower than the $1 billion implied value of that single stake. The bull case rests on two facts. WhiteFiber has successfully locked down regulated power, and they have secured the long-term enterprise tenants needed to pay for the build-out. But those high margins hide a brutal financial reality. This chart tracks WhiteFiber's free cash flow into early 2026. The company is deeply unprofitable on a GAAP basis, dropping to negative $166 million as they front-load the immense costs of building these facilities. Almost that entire $921 million backlog depends on the financial health of just two clients, Nscale and Cerebras. If either company encounters stress, WhiteFiber's revenue visibility disappears. They are also significantly subscale. This graphic compares WhiteFiber's $1.5 billion market cap against its larger competitors. IREN holds $21 billion, and Nebius dominates at $72 billion. In a capital-intensive race, WhiteFiber has the least cushion to absorb a mistake. This financial fragility is amplified by a structural market trap. There is a tiny public float of only 9.5 million shares available for the public to trade. With so few shares and high cash burn, aggressive bearish bets have piled up. By May 2026, short interest reached a record 38% of the free float. That skepticism sent shares into a steep dive, with the stock hitting a low of $10.51 in March, following a disappointing earnings print. The narrative reversed in May when WhiteFiber announced a $160 million 5-year Paris region AI compute contract. This announcement acted as a catalyst for a violent short squeeze. Forced to cover their positions, bears fueled a momentum surge that skyrocketed the stock price toward $40 by mid-June. Even with that rally, the balance sheet remains fragile. WhiteFiber is entirely dependent on continuous external capital at a time when interest rates have significantly increased the cost of debt. WhiteFiber functions as a highly leveraged call option on the physical infrastructure of the AI boom. Demand for compute is robust. Their ultimate test is sheer survival to scale. If management secures non-dilutive, permanent financing to finish their campuses, they could transition into a self-funding cash machine. Conversely, any equipment delays or tenant failures would allow the massive short interest to crush their tiny equity float. To predict WhiteFiber's survival, ignore the daily market noise. Success depends entirely on the physical revenue ramp-up at the NC1 facility over the next 2 years.